pandemic. Pandemic has affected everything, but due to technologies, we can connect all over the world, and we can, interact with the lovely mindsets and the great mindsets of people. And thanks to Startup Stairs for giving us this opportunity. First, before moving towards our guest, I would like Preet Sandhu ma'am, the founder of Startup Stairs, to enlighten what exactly the company is all about, what exactly this webinar is all about, and enhance more on this. Preet ma'am.
Thank you, Janvi. Thank you so much. I once again welcome all my audience and my guests speakers today, Manish Gupta from Growth Venture X, and also Vishal Jindal ji from Biryani by Kilo. I most welcome you on the behalf of Startup Steers. I'll give a very brief about Startup Steers before taking out the session. We are a seed stage accelerator, and we are based out at Gurgaon. So at Startup Steers, we have decided to get the startups at the early stage and nurture them as per our the program policies and guidelines. And we are a team of people from the different domains, the finance, legal, marketing, technology. So the team has core strength of all the domain experts, which are actually which is required as a pillar for any startup in the initial stage. So we are acting as a platform to connect investors, mentors, and startups together on one platform. And the most benefit to the investors, if I say from Startup Steers, is that they are getting a very credible, filtered, and a very curated startups. And when it comes to the startups, they are getting all kind of networking, guidance, and the mentorship which is required at the next stage. So that's how we have taken an initiative at the Startup Steers, and that is how we are organizing the webinars to make our audience, to make our people aware that how to when you start with any startup, how you take small steps and how you have to take steps with wisely. So that's how all about the Startup Steers, and I will not take much time. I again welcome Manish Gupta ji and Vishal ji on the behalf of Startup Steers. And Janvi, I guess you should take on the session with the speakers.
Yes, definitely. Thank you so much, ma'am. Thank you so much for your valuable words and information. Ladies and gentlemen who have joined us today, I would just like to inform you a bit about today's webinar, that Mr. Anant Prakash Pandey was supposed to be here, but because of some business priorities, he's not here. But we have our two lovely guests today. And officially, I would like to welcome Mr. Vishal Jindal, sir, the co-founder of Biryani by Kilo. Thank you so very much, sir, for being here. And also Mr. Manish Gupta, sir, who is the principal investing GrowX Ventures. Thank you so much, sir, for your delightful presence in this evening.
Hi.
Hi, sir. Good evening to both of you. And okay, so I guess let's give this webinar over to you. Vishal, sir, we would like to listen to you. And let's take it ahead and let this session be more interactive and more informative for all of us. So I guess you're on mute.
Oh, sorry. I guess the session is how to raise money from investors. I think so. I'll keep my focus there.
Yes.
I hope the audience knows about Biryani by Kilo. We are more than 50 outlets now in India. We are the biggest biryani and kebab delivery chain. We are in North India, from Delhi NCR to Jaipur to Ludhiana to Bhopal, Indore to East, Calcutta, Bhubaneswar, Guwahati to South, West like Mumbai, Pune, Bangalore, recently Goa. So, and we are almost 150 crore top line company now, and we have grown it in 5 years, starting 2015-16, and we have raised Series A and Series B. We have signed the term sheet, and we are in the process of raising next month. So I think it will be quite relevant for the audience here to know our journey, and I'll encourage everyone to ask as many questions, because of course we can give gyan, but I think it'll be more relevant if people ask specific questions. So happy to share our journey as transparent as, and I've also been in private equity and hedge funds, so I've seen the journey from the other side as well. So hopefully I'll be able to, should be able to help people with their questions. Yeah. Do you want me to take a specific question or take a specific point right now? Janvi?
Okay, sir. So basically, we have few questions that we would love to ask from you. Before that, if you would like to, enhance some point of views, or you would like to give your lighting on something related to a lovely pitch deck that we, as a startup, should maintain, you can give that. Otherwise, I have some of the specific questions that we can go ahead with.
So of course, see, I think I would always say that investors are quite smart. If I think the founders should keep in mind, and as long as you are doing your role of being a founder right, which is knowing what the business you are in, the business plan is made right, the founding team is right, and you know what you are doing right, I think the investors finally get it. It might take time. So pitch deck is a way of doing it. And of course, there are professional agencies today also who can, but I think the more crisp you keep it, I think it's better in terms of how your business is different and how, so both in terms of numbers and objective details, if it's well balanced, I think it'll be good. But I think more than anything, if you know your business, you are clear about it, that message will get conveyed. That's more important. You know what you're doing and what you want.
Right, that's true. Okay, so while you were successfully running a couple of private equity funds, how did you come up with the idea of becoming the co-founder of a startup of setting a cloud kitchen, which was quite uncommon in India?
So see, my journey, Janvi, I've done my engineering from IIT BHU, then I've done my master's from US, and I've been a successful IT entrepreneur in the first part of my career. And then I moved to hedge fund in Singapore. I was co-founder of a private equity fund called Carpedium Capital. But I realized 5 years back in 2015, when I looked at my life, that my DNA is more of a founder and an entrepreneur than being an investor. Different reasons for that, but I've been on both seats before that, and I've been a very passionate about F&B industry in particular and consumer industry. So, and I used to always wonder why we don't have a McDonald's or a Chipotle or a Domino's from India. We have such a wide range of food heritage, from Maharashtrian food to Gujarati food to all very varied food and very rich diversity in food and in heritage. So I think the answers were quite simple as an investor. That see, first of all, in India, uh, if I can say technically, the rentals are quite high. So if you make a dine-in restaurant, particularly, the rentals can be quite high, and the sales to capex, I'll get into detail later, those ratios can be quite low, and the return of capital, and it's quite risky. Also, see, Domino's in India has been very successful, which is 4,000 crore company today with 1,300 outlets. One of the main reasons is that Domino's sells pizza, which is a delivery-friendly food, and 50% of the sales come from delivery. So we knew if we have to really scale up a business, it has to be around a category in food which is delivery-friendly, and it doesn't have an incumbent leader. Like pizza has incumbent leaders in Domino's, Pizza Hut. Burger have incumbent leaders in Burger King, McDonald's. So it's not easy to compete with them. So biryani is a very delivery-friendly category, which is a one-pot meal, a combination of rice and meats or rice or vegetable, makes it very versatile. Uh, and we have a rich heritage. You don't really have to sell biryani category. It's already sold for a few hundred years. And and it doesn't have an incumbent leader in India or in the world. So the leader has to emerge out of India. It can't be transported from US or China. So having said that, we knew that if we have to succeed in F&B market, it has to be a delivery-friendly category like biryani, one-pot meal. It has to be without an incumbent leader. But the bigger challenge is also after that, if you get the strategy right, is how do you execute? Because in food, what is challenging is companies can do very well in Bombay or Dehradun or Jaipur or Bangalore, but how do you become successful in different cities and different states? So for that, companies like McDonald's and Burger King have SOPs, systems and processes which are very, very standardized. So you'll get the same McDonald's burger here or in China or UK or US. Most Indian companies have not been able to standardize their food across outlets, across cities, across states or countries. So we knew that we had to put the systems and processes in place from day one. Food is standardized. So in case of biryani by kilo, although our food is, we use the best ingredients and the biryani is made fresh on order in each handi. That is, and we do Hyderabadi, Calcutta, Lucknowi, three styles of biryani kebabs. But it's very standardized. So what you will get in Goa, BBK Hyderabadi chicken biryani or a Gosht Lucknowi biryani or mutton galotis or finni would be same in Goa or Guwahati or Jalandhar, Bangalore. So it is very consistent, and that can be only be done if your systems processes it's mechanized to a level how you hire, how you audit, how you train. So to answer your questions, I'll go back to your initial question, how did I change from private equity to co-founder? I've been an entrepreneur for the 10 years of my life and probably 5 to 10 years as an investor. So plus 45, I realized that my DNA is more being a founder, of course, and create the best legacy I can create is create a F&B chain from India, which we all Indians can be proud of, in our heritage, which is biryani, and make it a worldwide chain like Domino's or Burger King, but using the fresh food and most authentic way how our biryanis, Hyderabadi, Lucknowi are created. So I think I found my destiny and my calling there, and we are very happy. Like we are almost a 150 crore turnover now, more than 20 cities, and we are growing. If it was not for COVID, we would have grown to other countries as well. So I think it has been a good journey, and wish to take it forward to make it as big as Burger King or Domino's worldwide in biryani.
100%, sir. 100%. We all can see that future. And thank you so very much for a lovely, valuable thought for all of us. Let me just take this session to Mr. Manish Gupta, sir. Sir, first of all, once again, I welcome you. A heartiest welcome. Thank you so much for being with us. Sir, would you like to enhance a little more bit about, how to raise funds and about, that amazing pitch deck that we call, to all the startups, how to do that?
So, very good points that Vishal has already added. I'll add just a few more.
Yes.
By the way, just in terms of background, I represent GrowX Ventures. We are an
Yes.
early stage, seed stage, B2B focused tech/deep tech fund. Right, that's our focus. In terms of pitch deck, apart from what Vishal has already said, keep it crisp and keep it relevant. Make sure it has everything that needs to be there, right? So something as simple as defining the context of the domain or the subdomain you are attacking, the problem you are solving, right? So a lot of investors have a superficial knowledge of a lot of industries or a lot of domains, subdomains, but they don't know about it as much as you do as a founder. So it's your job to bring those nuances out. This is the domain or this is a subdomain I'm talking about. Set that context. Then take us a couple of slides to establish the problem statement. Who are the different stakeholders? What are the problems they're facing today? And these are generally true for deep tech, non-deep tech, consumer businesses, all of them. Set the context, set the problem statement. Who are the stakeholders? What are the problems they're facing? Then only get around to defining what your solution is, what you're going to do for what you're proposing to do. What are the benefits it has? What is the USP, right? What does it mean for these different stakeholders? For the customers, for the partners, for the users, for the buyers. The users can be different from buyers, for example, right?
Right.
And there could be an edtech business can be has stakeholders, not just the learners, but their parents also, and sometimes the tutors also, the trainers also. So it has to solve the problems of the both ends. Then take a few minutes, talk about this team slide. Why is the team right for this particular business? Why will the team win in this particular market? Because team is one of the most important ingredients in evaluating a business from an investor's point of view. Then there is stuff like competitive landscape. Who else is solving the problems you are trying to solve today. There is something the customer is using anyways today. What is it? What are the deficiencies it has? What is it that you bring to the table? How do you differentiate yourself from what is existing there in the market? Where can the competition come from in the future? Then a little bit about your journey so far. When did you start? What did you achieve so far? What are the targets for the first few years, for the next couple of years, in terms of milestones, in terms of hard numbers? And then from business to business perspective, you add more slides on the technology, on the product, on the revenue, on the business use case. They vary from business to business. I don't know if that answers.
Yes, sir. Definitely, definitely. This covers the most of the points. So basically, you seem to have an affinity towards seed stage funding in startups, and there must be some solid reasons behind this. So I insist you to throw light on why funding at a very seed stage is the best according to you, and is this strategy of seed stage funding followed by a large portion of other venture capitalists as well?
So, very frankly, we do seed stage because that's all we have learned to do in our short careers. We've been doing that, partly because we are a small fund, and the stage at which we play, we can bring something more to the table than just money. Our small pots of money are irrelevant for let's say what Vishal was saying, Series B onwards, right? Series B, Series C onwards, those become more games of money than everything else in the table. So when we do seed stage funding, our job is to find diamonds in the rough, right? We are the first ones writing the first institutional checks most of the time. So it's our job to find companies which have not been, let's say, visible yet, which have not shown through yet. And for those coming in afterwards, Series A, Series B funds, it's easier. It's just they have to look at the portfolios of funds like GrowX, right? What they have invested in, and then take it from there. So, and at a seed stage, a lot of Vishal has had a lot of experience, so he's, I would say, one of the exceptions. But a lot of founders are first-time entrepreneurs, or very young in their careers also. So they need a lot of handholding in terms of building a business, or just helping with the strategy, or even tactical stuff. They haven't built teams in the past. This is the first time they're building teams, for example. So all that handholding, all that all that experience we have accumulated as a firm, we can bring to the table apart from just money. So will be relevant, for example, in a Series B round. That's why we chose to choose seed. And plus, obviously, there are rewards, right? There are financial rewards, higher risk at an early stage and higher reward at an early stage. Apart from that, just the joy of seeing the companies you found, the founders you found, them creating larger businesses. Some of our early investments, for example, have raised large rounds. They have done their Series B. They are category creators in their own sense. So there are companies like Locus, Mad Street, Den, Find. We invested in them 5 years back, and they have been category creators in their own right. And something as recent as Space Tech also. So that's a part of the joy that gives us why do we choose seed stage. In terms of your, what was your sorry, what was your second question?
So basically, my second question was: is this strategy of seed stage funding followed by a large portion of other venture capitalists as well?
Yes. So apart from most seed stage funds, a lot of mainstream Series A, Series B fund, multi-stage funds have also started taking early seed stage bets. That's true. And then they have also the capability to write larger checks in Series A, Series B rounds. It's just that sometimes it can cut through both ways. So if a mainstream multi-stage fund is taking a seed stage bet, they are known to do Series A, Series B, but let's say out of 10, they end up backing only 4 companies in their Series A, and not the remaining 6. Then it's very hard for the remaining to find capital in their follow-on rounds. Because if a multi-stage fund which has the deep pockets is not writing a Series A check, then there must be something wrong with the business. So it becomes a little harder for startups to raise funds. The mainstream VC is not taking those bets. But again, horses for courses, each one to their own. So something different works for everybody else. So.
Yeah, that's true. That's true. There is different kind of strategy for everybody. So, Vishal sir, would you like to add some points to what Manish sir has enlightened? So, you're on mute.
Sorry, yeah. For the benefit of the audience, let me ask Manish on that. On the seed stage, would you be looking more at founder and following your instincts, because there might not be a very concrete business plan, or maybe at least not for the 5 or 10 years? And does the founder or his or her background becomes more important at the seed stage rather than the business plan? What will be more different what you look at a seed stage, because that will help I think the audience here. I think is it the founders or the background or the overall business what they're proposing?
Thank you for the question, Vishal. So we have I am relatively new to investing. I've been investing only for the last 2 years, since 2019. But in my short career, we have invested in companies where the founders were still in college, for example. Right, one of our famous companies from this fund is a company called Pixel. They were still in their 4th year when we invested in them. So they had a pitch deck when they came to us, and that's all they had, right? A story, a pitch deck, and their confidence. Obviously, we evaluate the founders. We spend a lot of time with them. We try to understand. It's not just about background or pedigree. It's also about how much. What all do they bring to the table? It's hard to put into words, but we do multiple meetings across multiple interactions across different partners to just make sure that we are backing the right horse. So the team is the most important ingredients. I don't think that's true just for us, but I think for most investors that the team is the most important ingredient. The market is obviously also important, but we all know market can change. The problem statement they're chasing can change. The early stage at which we invest, particularly GrowX, we invest at a pre-seed stage also. So pre-revenue, pre-product, most of the times pre-technology also we invest in. So there's no business plan also most of the time. There's no, in fact, there is no business plan many of the times. It's just a idea of a business plan, the product they're gonna build, the market they're gonna chase, and then we are also prepared in our head that this is all going to undergo a shift in the next 1 or 2 years. So most startups end up, undergoing some sort of a shift, some sort of a pivot in the first couple of years. So we are mentally prepared for that. The only thing that doesn't change is the founders, and hence the founder evaluation becomes the most important.
So I like to, just go on that question a bit more, just for the benefit of audience. So in fact, and Manish can correct me, so they are betting more on founders, if I can say, in the passion. See, let's say in a Series C stage or D stage where Carlyle or Blackstone comes in, the team is quite settled, the systems and process, the business is clear. It's not going to really pivot that much by C or D. So the business plan in that case will matter more. If I can say, more than the founders, the business plan and how it's going to play out. I think at the stage what GrowX or the seed stage funds would do, Manish, the founders or the patients, even if it's not a business plan or a pitch deck, it's just an idea, they can even back that. So that can be heartening for a lot of people here. So if you can be in college.
Just one point to Vishal, just one point. It's important to see your approach, how you approach your thinking, right? There should be a business plan. There can be a business plan. You may or may not have to stick to that. It may undergo a change, but it'll be nice to know where you want to go, right? Rather than just start running in one direction. So just a little tweak to what you were saying.
Right. So of course you like to see the direction, but I'm saying not entirely, but you can correct it. But at least the founders and the passion and the field they want to work in, and the team becomes even more important.
100%.
Even if it's not a very, very clear business plan, or because they know that it will pivot, it will change. The business plan at the seed stage might not have that much relevance, because of course it has. I don't want to undermine it, but it will change because no one really knows. But at a Series C or D stage, the business plan is sacrosanct, right? It will not change. It will not pivot. They are investing in a business which is 500 crore top line. So more or less everything has been. So I think the founders can take a lot of confidence on the fact that if they're passionate, they know what. It's not only the pitch deck, it's not only the business plan, it is who they are. And I think people like Manish or like Ashish, who I know well, are very experienced to instinctively also know where the founders. So if you are who you are and you are projecting it right in line with who you are, it will generally go through because people at seed stage are quite instinctual, if I can say.
Correct.
That's right. Okay, so Manish, sir, because you mentioned about Pixel, I would just like to enlighten few points regarding that. You have a vast portfolio with some great startup companies like Lightspeed Labs, Pixel, RSC Energy, and many more. So, what are the parameters that you look for in a company? Like where you focus more, the product, the services, the business model, the technology, or the consumer-centric approach? So, this is a question that many of the audiences are also asking in the chat column. So, guys and girls, ladies and gentlemen who have joined, we are trying to cover all the points in the conversation. So, I'm sure your questions will also be answered in some or the other ways. So, Manish, sir, would you like to enlighten what exactly do you see in a company before?
Sure. So depends on the business very much, but what Vishal just covered, the founder is the most important element. Then the market opportunity, whether there is room to play. I was looking at one of the questions and somebody is asking, my business got rejected because I'm in a competitive industry. So it's partly a founder's job to bring out the nuances of how they are different, right? Is there a room to play in a super competitive market? And if the business can become large, we also do, since we are a technology investor, we invest in especially deep tech. It's imperative for us to do a bit of a technology due diligence also. Sometimes, most of the times, in fact, the founders we invest in don't have a revenue, don't have a business in place. They are too early in their journey. They don't even have a product. Many times they have invested in companies when they didn't even have a technology, right? So it becomes important to at least vet the ideas they have, right? How sound they are. So, for example, Lightspeed AI Labs is looking to use light to do chip-to-chip communication, right? Something very, very niche. So the idea for an investor is to just then figure out the ideas the founder has. Are they rooted in science? Are they rooted in reality? Can they, take shape, or are they just, a cool science project?
Right.
So different things we look at. But the three names you mentioned, Lightspeed, Pixel, and Race Energy. So
Yes.
different actually stories about all of these three. Lightspeed, we were in touch with the founders for 1 year, almost since the inception, before we took the plunge and said, we'll be a partner in your journey. It was a pre-product, pre-tech company. They just had a deck at that point of time, and two very promising founders, and one of them had, for example, 38 patents in their name. So that's Lightspeed. Different reasons to invest in Lightspeed. Pixel, like I mentioned before, the founders were very young, 20 something, still in final year of college, very ambitious, very promising, and very mature for their age. The things they had thought through, they just blew us off. So it was an exception, at least for Proex, to invest in a company when the founders were still not out of college yet. Race Energy was slightly different in the sense that they had their business plan figured out, their goal figured out, what they want to do, and then they were working backwards from there. So they knew that they want to solve this problem. Now they need to build the pieces to solve that, build the hardware stack, the software stack, the infra, the batteries, and the conversion kits, and how do they want to go about it. They were working, they had the goal figured out, and they were working backwards from there. So different. There's no formula or a playbook. At seed stage investing, it starts with the founder, and you look at the other aspects. So it's very hard to say these are the three things we, if they are okay, then we will invest. It's very hard to say that, at least for me.
Okay, so just let's say an example, if a startup person, like let's say a very beginner coming to you and pitching about the business, what exactly would you like to focus on? what exactly they need to maintain in their pitch deck that you need to focus on?
Yeah, similar to what I covered earlier. Talk about the domain, the subdomain you're talking about. You're working in a set context, because we don't. Most investors don't know, what problem you're trying to solve. So you have to bring out the nuances. Like the edtech comment I was reading, it's on the founder to bring out those nuances of the problem they're solving and the solution they have and the benefits it will have for all the stakeholders. It's up to the founder to
Yes.
bring out those nuances. Like somebody said, I was just reading, the investors have a short attention span. That's true. They are hopping from one meeting to another. It becomes a little bit of a founder's job to figure out, how to hold their attention. An elevator pitch is a romanticized idea. It doesn't have to be an elevator pitch. It can be a 10 minutes, 20 minutes pitch. That's all right. You have to hold their attention for a little bit of time, and do a bit of storytelling, for example. Learn a bit of storytelling. Practice your pitch, for example. Right? Do the basic hygiene stuff. Practice the pitch in front of a mirror, for example, or with a friend, and see what you think you are saying. Does it come across like that, or it's just something else coming out of your pitch deck? So it's the same message about what you think in your head. So do those basic hygiene stuff before you go for a pitch meeting. It'll make it slightly more easier.
Right.
Well,
Thank you so much, Manish sir. Thank you so much for your valuable thoughts on this. Vishal sir, I would like to come to you and I would like to ask you regarding your journey from bootstrapping to raising funds in millions in just few years of business, because everybody is looking up for some kind of dreams they have. Like you had a dream and now you are like having a revenue of like amazing revenue that I should not mention the digits. So would you like to enhance your journey? So mute.
So there is, I would say, nothing to hide there. We are doing 150 crores kind of revenue,
Yeah.
and so see, like Manish is saying, first of all, this you have to keep doing it. Like he said, a company they met for 1 year, right? The people who were in college before they funded them. So it's not really the pitch deck or something, that just gets you on the way. Maybe the first meeting, and Manish and Ashish, Roex, so all the investors, they're smart enough. If you are good, they will, even if you might not be the most best pitch, you might not have the best pitch or the way you project it. They will know if you have, because if finally being a founder is like running a marathon for 5 years, 10 years, 20 years. So do you have it within you? You have the focus, you have the discipline, you have the interpersonal skills. So they are the best judge. I think that's all they do, right? It is their judgment, which an instinct they've honed over the years, and that's what they continue to do. So I just want to bring in the point. It's not only the pitch deck that gets you there, right? But they are smart people. As long as you have done your homework right, you have the integrity, you have the interpersonal skills, you have the focus, clarity. You bring something to the table which the world needs. They more than likely they would. I think more than what you have to, someone should do is hear someone like Manish out or an investor out when they're looking, giving the pitch deck. Or see, I think people like Manish or investors, seasoned investors, have a lot of experience. So they will always look for the loopholes in your business plan, in your personality, in your journey. So you have to see, I always say, you can have a wonderful boat, but it needs one hole to sink it. So you have to look at your holes in your boat, which people like Manish can, very easily, given their experience and a lot of those investors. So I think you have to listen more to the investors, look for honest feedback. You have to be honest enough, you have to have intellectual honesty to be honest about what your roles are. See, for some people it can be technical, for some people it can be marketing, for some people it can be building the right team together, for some people it can be commercial skills. So I think, coming back to your question, see, it helped that I've been in the successful entrepreneur before and private equity and hedge fund world. But when we were starting on, biryani was not so hot the way it is now. If you look at Zomato, Swiggy, they will say you sell so many biryanis in a second. Biryani is hot, or cloud kitchens are hot. So 2015, there was no concept of cloud kitchens. But we knew that if you have to do well, so you have to be able to see things which people might not be able to see at that particular stage, and run with your conviction and have conviction in it. So I am, like I said, I've been an investor in this consumer industry and F&B industry. So I knew well that a product to succeed and to become 100 crore, 1,000 crore, or 10,000 crore, first of all, you need a category which is very deep, like biryani, which has to be delivery friendly. And you don't have an incumbent leader, really. So we knew, and if you do delivery, you can do outlet in 30, 40 lakhs versus a dine-in, which is 1 or 2 crores. And if you get your numbers right, being an investor, I knew if you do 20, 30 lakhs, see, Domino's is Domino's because they do 30 lakhs per month per outlet, let's say, compared to a Pizza Hut delivery, which do 17 lakhs. So magic happens at certain numbers. So you have to know that what are those numbers. So given my background, I knew and I would know that industry better than most people, what it will make it work. Despite that, it was not so easy because see, either you can be behind time or ahead of time in your business plan and in your, so I believe we were ahead. So when you're ahead, it takes certain believers to believe you because you are ahead of it, to people to believe in cloud kitchen or biryani. But today, people who might launch a cloud kitchen or biryani, they will be, if I can say, a bit behind the curve. So because it's not so easy anymore. We have the first mover advantage. We are already in many cities. We are the leaders. Although it's not a winner takes all market. So if you're behind the curve, you will have people easy to convince. But then you don't have tailwinds behind you. You have more headwinds. So you have to realize what part of the curve you are. So you can choose you are ahead of the curve, but it will be difficult to convince the investors because they also might not be so much ahead of the curve. But you have to see, a founder is a specialist in a particular field, be it be AI or cloud computing, not cloud kitchen, cloud computing, or robotics, or genomics or gene. It can be anything. A founder is supposed to be a specialist, not a generalist, and passionate about a particular field and supposed to know more about that field than any other investor or founder. If you know that, and if you have passion and or a desire to know, I think it will come across, and a right combination of technical, commercial, and interpersonal skills. And I guess I had that in that field, and it came across to investors. And given my background, it helped. So I think.
One point I wanted to add to what Vishal just said, not the
Yes.
history of biryani by kilo, but the investor feedback.
Yes.
Just know that a lot of these investors like us have very superficial knowledge about a lot of stuff. So you have to take a lot of our feedback with a pinch of salt. You have to figure out, every investor is looking for something else, looking out for something else. I will give a different feedback. If Vishal is an investor, might give a different feedback. But you have to, if you listen to all, you'll go, mad. So you have to filter out the right feedback. You have to figure out what makes most sense, what is the most logical. And like Vishal said, we have the intellectual honesty to accept some of the hard truths, hard facts which you might come across. If I say that you are not good at this XYZ, then you can choose to reject that suggestion, or you can choose to say, let me just think about it. Why did this person say this? Is there any truth in this? Can I go and work on this? But again, keep take everything with a pinch of salt is my only 2 cents.
Okay, I guess that's a very helpful tip, Manish sir, that you have added. Thank you so much, Vishal sir, for sharing your experience. I would like to ask a very general question on behalf of our audience, also on behalf of our team, also. So, what was your plan on how to raise funds at a very initial level back in 2015?
You're asking me, Jana?
Yes, sir.
So I think when you are at this right initial stages, you will go to HNIs and angel funds or seed funds. So that was the plan. And because, like I said, I'm a bit experienced in this field, so we
Yes.
approached the angel funds and the HNIs. And like Manish said, people, investors have their own inclinations, own prejudices, if I can say, biases. GrowX they are towards deep tech. Some funds would be towards consumer funds, right? Like Fireside is towards consumer. So you have to know which side or what inclinations an investor has. seed stage, a bit concept stage or revenue stage. And if you, and there also you have to connect as a person, both people, because to a certain extent it's a marriage as well, right? You have to sell yourself also, not only the business plan. So having said that, it, of course, in hindsight, it's simple. When people ask me how you crossed IIT 30 years back, sometimes it's, I don't remember, but, it is always difficult at that stage. It was difficult, but I think you have to keep doing. If you know what you are doing, people will come through. आपको पता होना चाहिए, if I can say in Hindi, आपकी गाड़ी किस डायरेक्शन में जा रही है, आप चलाते रहो, लोग बैठ जाते हैं धीरे धीरे. आपको पता होना चाहिए, but you should know as a founder, like a specialist, like Manish said, there investors are generalists and they go for different stages, different consumer tech. Some people in FNP, a lot of company investors in India didn't have a good experience, right? So it is not easy to raise money in FNP because most investors have burned their hands. So you have to be cautious there. So they think, someone is again telling a story. But if you are convinced what is right, you have to keep doing what you have to do. It will come through, right? People will get aligned. So you have to be convinced about and keep plugging your holes through the right feedback. It be some, like I am repeating it, some people might have, it is the communication skills or the team or the commercial or the tech part. Keep plugging your holes. Investors, I'm trying to underplay that, but they will come. So I think because आपकी गाड़ी चल रही है, तो FOMO भी investors को भी FOMO होता है. They will also come. So you have to be convinced about your अपनी boat कह लो, गाड़ी कह लो, and the journey and the direction. Investors will come, people will come. You have to have the intellectual honesty and the conviction and clarity.
Right, sir. So, what according to you should be the best time for a startup business to approach to the venture capitalists?
So like Manish said, it can be you are in college, it can be while you are doing it. So there's no right time. It is like, I'm again, I use so wrong similes. It is like it is the right time to get married, or what is the right time to do this. See, no one really knows. See, you have to keep doing. So, but you should have, see, I would say money is like the blood in your body. Money is like cash. If you run out of blood or heart stops beating, you're dead. So you should never run out of money. So that is important advice. You should not run out of money. You should always have money depending on your risk propensity from 3 months to 1.5 years. You should not have money for 10 years, but 3 months to, if you are a very, very initial startup where you're just bootstrapping 2-3 people, if you have money for 3 months, it's okay. But when you have responsibility for 50 people, 100 people, you should have money for 1.5 years. But as long as you have money for 3 months to 1.5 years, you're okay. Depending on your stage. Manish can maybe put more.
Very true. There's no right answer when you have to raise money. For some businesses need a lot of capital to get started, but a lot of businesses can be bootstrapped in the beginning. At least initially. And the most important is why do you need money is the first question, right? A lot of businesses can grow well even without raising external capital. You end up diluting, giving away 20-25% of your company to an investor who's going to just come and sit on the board and ride on your success. So you have to be very, very clear. Equity dilution, equity financing is expensive. You should do it only when you really need to do it, when there is really a burning need. So for example, if without money you can do X in, let's say, 1 year, with this money, by raising money, maybe you can do 5X or 3X with that money. Maybe then it makes a lot of sense to dilute your company a little bit and make sure that you make the investor also get the fruits of their what they're risking. But otherwise it's not necessary to raise funds to run a startup. Delay as much as you can. Obviously there is an opportunity cost that if you delay financing, does it slow down your progress? So there's no right time. It's a customized answer for everybody, for each use case.
So like Manish is saying, I'll take it forward. आपको decide करना पैसे किस लिए चाहिए. If you are a tech company, maybe you need to build tech for the first 6 months a year. So you just need to pay salaries. You don't need money for marketing or advertising or go to market. So you need money for that people to pay salaries, right? So you should know what
Right.
you need money for. See, the most money you need for is for distribution or go to market, etc., or market. So that's where you really need to amplify. But by that time, your product market fit has to be right when you're ready to spend that kind of money in marketing, advertising, or go to market. So the initial part is always the product market fit or creating the product. For that, you generally don't need that much money. It is a finite amount which you should know whether you need for salaries or testing the technology or the product or running, let's say in case of biryani by kilo, 2 3 outlets. So I always encourage investors to get that product, sorry, founders to get that product market fit right the initial time. So for that, you don't need money, you need patience and hard work. You need some money, but more patience and hard work and clarity. So like we started biryani by kilo, we took first year we only did 2 outlets because we wanted to get the back end, the systems and the process right. It's easy to make biryani or maybe great biryani, but to make it consistently every time without much supervision with processes requires building a very robust backend, right? So that requires work. So you can make it like a McDonald's, the biryani, even if it's authentic, it's very authentic, the high best quality ingredients, but can it be made? See, most people focus on the front end कि बहुत बढ़िया ऐप बना दी, बहुत बढ़िया marketing कर दी, but the back end never not work that much amount of work which is required. See, front end and the consumer marketing or anything can distribution can come or in B2B, but first you have to work on the back end right, the product and the product market fit. That takes some time, I think, and that doesn't require money. It requires patience and clarity. Some money, yes. So you have to be clear about those stages in business.
Yeah, that's true. That's true. So, sir, Vishal sir, as a co-founder, would you like to share some do's and don'ts to our prototype business, all those people who have joined us today for the benefit of the audience, because they all are at the initial level of their businesses. So, as a co-founder, would you like to share some kind of do's and don'ts that they should avoid doing or they should definitely do in the particular business? This could be a very generic thing for any field. So, would you like to enlighten some points regarding that?
So do's and don'ts are like very it is like, but I think broadly speaking, you have to be committed to something. You have to have a vision, a passion. See, I think I'm a big believer as a founder. I'll go a bit philosophical in tapping your emotional energy, where your emotional energy lies, in what field, what business, what things you want to really do, what makes you happy. So do them, but then you have to also look into yourself. What are the shortcomings you might have as a person? Are those technical skills? Are those commercial skills? Are those marketing skills? And get people around you. They can be co-founders, they can be team to supplement that. You have to have the intellectual honesty to accept what you bring to the table and what you don't bring. What is more important to understand is what you don't bring to the table, and surround yourself with people, the team, and the co-founders, and value them. The value system has to be right. You have to know that the co-founder, the team members are not either temperamental or don't have the right ethics. So you have to screen them for that. But you should be very honest about yourself, what skills or what this business requires, whatever you're trying to build. Be a great technical person. You might see Mark Zuckerberg might be a great technical person, but Sheryl Sandberg brings a commercial skill to the table. So you have to have the intellectual honesty to recognize that what is the gaps in this business plan or this vision, and who brings and who will fill in that gaps, and do those people have the same kind of tenacity to go along with you for those 5, 10, 20 years, and the same value system in terms of, if I can say, ethics, temperament, etc., to go along with you. Can you be friends with them? Once you have that, keep doing it and keep plugging your holes by talking to right people. Have the intellectual honesty.
All right. Thank you so much, sir. Manish, sir, would you like to add some of the points that what kind of do's and don'ts our founders have to, put in their pitch decks or something to, pitch a particular investor or some kind of like that.
But Janvi, I like to interject. Yeah, because sorry, mother, I'm being a. See, pitch deck is not the main thing. It is what you believe in and who you are. And you pitch deck. I think I don't want to give so much importance to pitch deck, and Manish can comment. It doesn't change much, and Manish
Yes,
should
sir.
comment.
No, agree with Vishal. The pitch deck has to be short and crisp, and see understand the process, right? You send in an email directly or through a contact to one of the VC funds. They only have your email and maybe a pitch deck to look at before they say let's go and meet, right? Let's meet. So it has to be good enough that it calls for a meeting. It has to be short and crisp, like Vishal said. It should cover the problem statement and everything else we discussed so far. Maybe don't send a mass email to all the investors. Maybe in terms of don't maybe research the fund like Vishal said earlier and figure out which fund is right for you, and then write write an email which says why you are right for this fund. Somebody was asking, should we go through a portfolio founder? Yes, why not? If you can figure out a person in your network who knows a particular VC, why not? But beyond that, pitch deck has limited shelf life, right? It's the founder, once you have the first meeting, first interaction, that's when things take off. So in terms of do's and don'ts, I don't really have a standard answer. Really, there's so many do's and don'ts, but I don't think I need to cover all of them. Maybe you can come up based on the specific questions if somebody is asking.
Yeah, okay. We can take some of the questions from the audiences as well. Like Nidhi is asking how to value your startup at the initial seed stage when you only have business plan. How much equity we should dilute?
Okay, I'll take this one. So there's again no formula. It's how much FOMO you can create in the investors, and how much you are willing to dilute, how much you are willing to raise, how much the investors need to have in the company. It's just a combination of that. It's very hard to put a formula there and say if you have this is the valuation you can expect. It's very hard. So the valuation can vary from a few crores to a few millions. Petty. So the same business being championed by an experienced, let's say, founder like Vishal will get very good valuation right out of the door than somebody like, let's say, me, starting this right out of the college. So no one size fits all.
So let me try to answer it in a different way, and Manish can validate it. So see,
Yes.
let's say someone like GrowX might have a ticket size of, let's say, $500,000, which is just sweet spot, which they do at seed stage. Will that be correct to say $500,000, $1 million, $500,000 would be the
Right.
sweet spot, 2 to 3 crores, right? 4 crores. And I'm just trying to give an example so people, it's more practical. Okay, they will typically, let's say, like to, and Manish can of course correct me, I don't know, 2 to 4 crores generally in a startup, because they know that 50 lakhs will not take them anywhere. Like it is like putting money in the well, right? So their sweet spot is 2 to 4 crores, and they will like typically a 20% of the company, let's say, right? So they will typically value an initial startup at a seed stage without a business plan at 10 to 20 crores. If it's very good, 20, 25 crores. If it's okay, average 7, 8 crores. So the range will be 7, 8 crores to 25 crores, and they like to put 2 to 4 crores. So you can do the maths by doing that. If you do enough research on GrowX, so someone says that is just, and Manish should correct me, I don't know that. So, but I'm saying what I know the seed funds is they like to put 2 to 4 crores and say, okay, we need a valuation of 8 to 25 crores. If it's really good, they might give 25 crores. If it's okay, they will give 8 crores. They like to have 15 to 30%, right? Starting stage.
No, very true. And, actually, I was doing a very high level this thing, but very good, Vishal, that you gave an example. So the valuation, like I said, is back calculated. How much you are willing to dilute, how much the investors need in your company. It could be 15%, it could be 20%, 25%, sometimes goes up to 30% also. And you come to a valuation. There are very few businesses where the valuation is figured out by, let's say, the monthly revenue you are making, let's say in a software company. If you have a software already made up, you are selling it in the market, there's a revenue which is recurring revenue you started making, and then there's a certain multiple on that annual recurring revenue you can apply, and then bring out a valuation and then add premium to, let's say, how much the founder experience they have, or how hot the sector is. So there is again no one size fits all. It's an iterative process to reach a valuation.
So annual revenue, yeah, EBITDA per multiple starts coming at maybe few hundred crores top line. When before you start looking at EBITDA, which in Indian startup case, even the IPO companies might not have EBITDA right now, the startups.
Yeah, not
So
EBITDA, but let's say you're building a SaaS business, right? There
yeah,
is a
yeah.
recurring revenue
Top.
you're getting.
So I think in a SaaS business, typically you get maybe 5 to 10x revenue, right?
Yeah, 8 to
In a
10x, right?
consumer business, you might get 3 to 5 times revenue, right? But before revenue, if you're going on a seed stage, you have to look the sweet spot of the investor. They want to put 2 to 4 crores and want to own typically 20-25% of the company. That is the sweet spot. So it is not because of who you are and the business plan. It is what the investor wants to own at the price. They know 50 lakhs will not do anything, or 1 crore. It will be meaningless. They want to put 2 to 4 crores to take you to the next milestone of Series A or something, right? So that how the valuation is derived.
Also, this definition of seed and pre-seed also have gotten diluted, right? But Vishal is saying 2 to 4 crores. Maybe now people are considering those as pre-seed rounds, where there truly is nothing on the on ground. And seed stage starts maybe $1 million onwards, right? And then you have
Yeah.
different parameters to evaluate at that stage versus what you evaluate at, let's say, pre-seed stage.
So if Kunal Shah is raising a company CRED, he might have a have a valuation at a concept stage of few $100 million or $1 billion. Or Thrasio kind of company might have a 40 million. But for a typical founder, you should expect a 2 to 5 crore. Typical, I'm saying typical, I mean a normal person, not a Kunal Shah or not a someone who's
Yeah.
a seasoned investor, right? Not a Mukesh Bansal, right? You're talking about a normal person getting out of college, normal people. By the normal people, I mean people who don't have a startup experience, who are trying to build. But if they have a good plan or good, and the investors get it right, they will typically get 2 to 7 crores at a, and the investor will like to own 15 to 30%. That is the key.
True.
All right. I hope we have answered Nidhi's question. Nidhi, thank you so much for your question. Audience, you can definitely ask some questions because we can have some kind of, we can grab more knowledge. Okay, so I would like to read out one question that we have received right now. We are tech-heavy asset light model startup. We have completed POC with MVP and received good traction with paying customers. We now looking to raise funds to build our tech platform, build team and wider marketing. We can scale faster with funding, else we will have restricted growth with our bootstrapped funds. My question is, should we spend available funds in next 6 to 8 months to build more traction, or hold on spending to increase runway and keep trying to raise angel or seed fund for growth?
Okay, I'll go. So, a lot of my portfolio companies I advise should have at least 6 months of runway in your bank. If you have 6 to 8 months, it's a balance, but you have to strike between how much. See, if you raise now at a lower, let's say, growth, you get a slightly lower valuation. You dilute a little more for the same amount of money. If you raise maybe 3 months down the line, 6 months down the line, then you have more traction under the belt. You can get a better valuation. But again, it becomes also slightly riskier, right? The funding climate may change. Today, we are seeing funding being closed very quickly. But a typical funding process, even in a bull run, might take minimum 3 months, right? And in some cases can take 6 months. And I've seen good companies take even 1 year. So it depends on case to case whether you are confident enough that you'll be able to quickly raise money, then spend that money on traction. But you can do both. For example, you can start having initial conversation with investors, keep them interested, keep on showing your progress every couple of months, and then do a dipstick with some of the VCs also, that what is the right traction I should have to come to you for you to invest in me. Do figure out a way to do those friendly conversation, do a friendly dipstick, and then take a call based on that, whether this is good enough traction. Can I raise this much money for my next phase of growth, or do I need to have more traction to be able to be interesting for you? So.
All right. Thank you, Manish sir. Vishal sir, would you like to add some points to this?
No, I think Manish is the expert in this particular field, but I think depends on anyone's risk propensity also. and you have to see how much is your cash burn. Also, see, specifics matter. If your cash burn is 2 lakhs a month, right, and you have a 6 to 8 months cash, it's okay. आपको 2 लाख रुपए और 6 लाख रुपए 8 लाख फाइनली आपको कोई, if you're a good business, people will not let you die. If your cash burn is 20 lakhs a month, right, the specifics matters, right? So then you have to be careful, right? If you don't have 20 lakhs a month and you have 20 employees, payroll to meet करना ही करना है, right? कुछ और meet करो नहीं करो. So you should always have money to meet payroll. If you don't have money to meet go to market or things, those can wait. You can take more risk. But payroll, matlab, you have to be careful. Things like that. So specifics matters. I think there are no one fit answers.
Correct. And don't err in any extreme. Don't have don't start raising money when you still have, let's say, 10 months of the runway still. Or maybe don't wait too long to raise your next round, because if you have only 2 months of runway, you are in a desperate situation. You end up taking whatever deal you are offered. So take the middle path, but based on your specific.
So you should have a good handle depending on your specifics. आपका burn rate क्या है, आप किस stage में हो, product market fit stage में हो, या go to market stage में हो, things like that you should have. And you should have maybe one founder who's focused on fundraise and rest people are working on what has to be done.
Okay, thank you so much, sir. Okay, I guess we have answered your question. Quick one. Yeah, okay. Moving on to the next question from Harshal Fuse that we have received. How to include an executive summary in a pitch deck? Executive summaries have long been a critical part of starting a business and securing funding. How do they play a role in today's modern fundraising efforts? Should you even have an executive summary slide in your pitch deck? Is the question from Harshal Fuse.
Not necessary. You can put a small, let's say, a summary. You can give a summary in the covering email. The pitch deck can take its own flow. You can choose to include a summary. For me at least, it's not mandatory.
See, I think all the things like executive summary, pitch desk, I want to reiterate, are to get to that first meeting with the investor, nothing else. After that, the investor knows they're seasoned enough. If you are worth it, they will also chase you, right? They will know after that first meeting if you're worth it and if there is a match. So they only to have that first meeting, you have to keep it in mind. It is actually the business and who you are and the team you have created. Is it worth it? See, it is also the investors who are looking all the time for the right founders and the right company. So if you have met them once, they know if you are right or you can be right. They also know. So pitch desk, executive summary. So I don't want to put too much importance.
Yeah, don't fixate too much on the right format and these specific slides, and just convey the message and get the first meeting.
So I don't want to put. Finally, आप मनीष का घर ढूंढ के भी पहुंच जाओगे, and he knows you are right. हो जाएगा.
That's awesome. Okay, so there is another question that I would like to take. Keeping all other parameters same, what do you prefer more in founding team from investment perspective? Number one, passionate young out of college, or passionate with many years of corporate experience?
Both have place in this. We have invested in both kind of companies. We have invested in companies, like I said, folks still in college, or maybe 1 or 2 years out of college, or folks who have spent years researching on a particular topic. Like I mentioned, the founder of Lightspeed AI Labs, he's got 30 years of experience and got, I think, 38 patents in his name. So depending on the business, right? In a research-oriented business, on a tech-oriented business, sometimes deep tech experience helps. But in a lot of businesses, younger founders have more capability to hustle. But again, it's hard to put a bias like that. You have to look at the team, whether this team is right for this business, for this problem which they're solving, which market they're attacking. Are they building a global business? Do they have the capability to build that business? Do they have the capability to build a team, like Vishal mentioned a little while back? Very young founders, they may or may not have the right skill sets to do for the go-to market for distribution. So are they willing to get a third or a second or a third or a fourth co-founder or a senior executive in the team to help them with everything that they don't know of? Um, no one answer. We have done both kinds.
Okay. Okay. So, sir, there is another question. How to evaluate whether term sheet is founder friendly?
I'll let Vishal answer that first.
Yes, sir.
No, I think, see, let's say an investor is asking, see, finally they're investing in equity, not debt. Let's say if investor is asking for IRR, and I think, of course, Manish will comment on, if they're asking for a fixed IRR or a fixed return or a certain, of course, investors will ask for a drag after 5 years, things like that. But if they're asking for a fixed IRR, they're trying to put conditions like they want to see every check signed, like they want to have authority that every check they will co-sign, or they're asking for 50% of your business. So those are red signs. They're asking this. I have heard about HNIs. They say, I'll put 2 crores, I want 50% of business. I want to sign every check, or I want a certain kind of return. So those are red flags, and of course, a reputation of an investor, be someone like GrowX or some, it goes beyond. You can always research, you'll know that these investors, because a lot of times investors don't know, some new investors who are HNIs and they just want to park their money. So people like GrowX are very seasoned, they're founder friendly, I can vouch for that. So see, they are founder friendly because they know if the founder works and the business works, they make the money, not the other way around. They can't squeeze value out like a debt collector, where they can squeeze because there's no collateral really. There's no house there or the car they can
No,
finally
you'll
take
be
back to
surprised.
their
You'll
home.
see some shit like that. Yeah.
Uh,
You
so you have to see the term sheet in terms of how much stake they're asking, check signing, or the return. So finally, a good investor knows that what money they have given is given. If the business grows and does well, they will get their money back. Otherwise, there's no way out. If the term sheet is reflecting that, this means you are in good hands.
Correct. So, as investors, we trust the founders once we have, let's say, made an offer to invest, and then we just negotiating a term sheet is a matter of finding the right balance of investor needs and founder needs. But one thing is for sure, no founder should go into these discussions or these meetings, or at least have a lawyer look at the term sheet if you don't want to spend taking them to these discussions, but at least have a seasoned entrepreneur or somebody who's done this before to have a look at the term sheet for you. There are term sheets which have unfair this a few VCs or syndicates, they start with a very unfair term sheet and see उसमें से क्या they try their luck, will ask for some outrageous terms, and if we can get them, why not? So somebody will ask for a 2x liquidation preference. There's something, if the company is getting sold, they want minimum 2x of their investment, irrespective of how much the founder is making. So that's not a founder friendly term, for example. We insist on a board seat, for example, but like Vishal said, I know a few investors who ask for co-signing rights. That's just to honor us on the investors also. Just that's just like you don't trust the founder, right? The founder, with whatever kind of effort you can put in, you can't chase a founder, you can't diligence a founder all the time, you can't look at the bank statements every month, you can't do a forensic analysis on the company. You have to trust the founder implicitly or explicitly, whatever, right? So a term sheet has to be looked at in obviously case to case basis. It's hard to say what is, but there are standard, some standard things like Vishal said. There can't be a fixed IRR the founder is supposed to give them. There are tag along rights, there are drag along rights, which are pretty common, and there's a logic. Try to understand the logic from the investor. Why do you want this right? Why do you need this right? Ask them, question them, right? A good investor will always make you comfortable with a particular right they're asking for. So
if I can, this is an important point. So I like to maybe add in a few things. See, I think a reputation of an investor is very important. See, no matter what they say, see, a GrowX, let's say, has a reputation. You can check it out, right? And or a Lightspeed or Secure or someone. So I think the reputations matters. How do you behave? How does an investor behave when a company doesn't do well or does do very well, right? Those reputations matter. right? A good investor will always know, at least a seed investor, if not Series C, that they're investing on an idea, on a person. घोड़े पे आप दांव लगा रहे हो, if I can say in Hindi. अगर चलेगा तो चलेगा. Beyond a point, आप investor is saying कि मैं check sign करूंगा, इतना IRR दूंगा. If they can at best be your guide, your friend. See, they can do as much due diligence till they sign the term sheet or give you money. After that, it doesn't work. No strong tactics really work, and the investor knows. A good investor knows, right? If your investor's role is to really do the due diligence and invest in the right person. After that, you can guide, you can do certain things. So if they're trying to bring in things in the term sheet or SHA where they want to have too much control, if I can say, this means somewhere they don't know, because after that, no matter what they do, they don't have the bandwidth to do it, right? They don't have the bandwidth. So if they're trying to do it, they're novice. They're trying to do it. See, like liquidation preference also, what he was saying, Manish, 2x. See, in a startup, what is a liquidation preference? Nothing, right? Who really gets what is there in a startup to sell and get liquidation? So anyone who's trying to get more than 1x or 1.5x is just pulling themselves more than the founder, right? There's nothing to liquidate. There's nothing really to liquidate, really speaking. So anyone, so more than, see, other than the intention, you have to understand this, how seasoned the investor is. A seasoned investor knows कि आपने घोड़े पे दांव लगा दिया है, now it is over.
Yeah, true. And this term sheet negotiation process, use it to till the time you have given somebody a term sheet or somebody has received a term sheet, everybody's trying to quote everybody, right? I'm trying to quote the founder is trying to quote the investor. But when the term sheet starts, that's a time actually you build a long-lasting relationship. Don't palm it off to your lawyers कि आप कर लो negotiate and I'll not come into the room. That is the right time for you to probe your investors, ask them hard questions, for the investors also to just find the right balance. That's a time when you build a good relationship with the founder, which will last you at least for the remainder of the investing period.
All right, sir. There is another question that I would like to read out. Manish, sir, this is from you. How do you consider the companies approaching for investment which were doing good business prior to COVID, but now struggling for their survival?
We have seen this in our portfolio companies, so we understand that COVID has been a reason for a dip in certain businesses. So we give that discount to the founders or to the businesses that this is the dip because of that. So we give them that let's say benefit of whatever, right? So but beyond that, it just you evaluate the business on the merits of the idea and the founder and the market size and everything else. At least that's
Okay. Vishal sir, would you like to add some points to this?
So I think I'm just reiterating whatever I've been saying. You have to know who you are as a founder, the business you are in, have the conviction and focus. आप इन्वेस्टर पे आप एक ब्रॉडर कॉल लो कि वो ठीक है कि नहीं, सीजनड है कि नहीं. Beyond that, can you have a relationship with that person? Can you actually say that investor is a decent human being? If you can say that person is a decent human being and a seasoned investor, that's good enough. Then that person will be with you because they know it's a tough journey. And they also know mortality बहुत है, right? अगर होगा तो होगा, नहीं होगा तो कोई कुछ नहीं कर सकता. As long as they understand it, they're also taking a bet. You're also taking a bet. You're taking a bet on your life and time. They're taking a bet on your money, their money. It's okay. As long as you are aligned, you can be friends. You know that is you're dealing with a decent person and a seasoned investor. That's more than going into every detail of the term sheet.
Right. Okay. We have a question from Palak. How do we realize our idea or plan is rock solid and we should believe in it and go ahead with it? Like what particulars need to be checked right for going ahead with our ideas? Okay, I guess this is the question of most of the beginner entrepreneurs that have joined us today.
Manish, you want to answer or I can answer?
You are the founder. I'll let you take a stab at it.
देखो, आई थिंक आप जो सवाल पूछ रहे हैं ना, जो भी आई थिंक ये सवाल, आई थिंक इट इज वेरी, आई थिंक दिस मीन्स यू आर नॉट, यू नीड टाइम टू बी अ फाउंडर. सी, आपने अपनी इंस्टिंक्ट्स डेवलप नहीं करी. इफ आई कैन से वेरी क्लियरली इन हिंदी, सी यू हैव टू डेवलप योर इंस्टिंक्ट्स एज अ फाउंडर, हु यू आर, व्हाट योर जर्नी इज इन लाइफ. इसका कोई राइट आंसर नहीं है, लाइक मैरिज की, व्हेन डू आई गेट मैरिड, हु डू आई गेट मैरिड, व्हाट शुड बी द ट्रेट्स ऑफ अ पर्सन. You have to develop your a, 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 a startup is like a marriage, even more than a marriage, right? You have to
More than a
develop your
marriage,
own
yeah.
instincts around it. What do you want? Whether you want to live that life, you believe in that passion. There are no right answers. No Manish or Vishal can give you those answers. You have to develop those instincts through your journey of life. You have to develop yourself as a person, your passions, your journey. How, see, life mein, I believe, I'll go a bit philosophical, there are two things: love and work, right? So work part, you have to develop your instincts as you develop for your love or your personal life, who you are, what you want, how you want to live your life on a daily level. So investors are a part of that journey. That instinct and whether that idea is right, you have to live it. And courage is a very important part of being a founder. No one can replace that. Like if you don't have that courage to live your experience and live with your mistakes or live with your downside. See, in a boxing ring, it doesn't matter what you can hit. It's the what you can take. So it is the downside you can live with. It is, do you want to go through that experience no matter what the downside, and enjoy it and be happy and have the trust in yourself to bounce back no matter what happens and love that experience. No one can tell you that. You have to grow as a human being to be that.
One point to what Vishal is saying, very true, and just a different way to say, what Vishal is already saying. Figure out the why of what you are doing, why you are doing. Why do you want to start? What is the reason for you to start? Will you still do it whether there is no funding, whether there is no external validation? Would you still do this? Will you still start the business? Will you still keep at it whether you have the money or not, whether you have the funding or not, whether the rest of the world is supporting you or not, whether when you are down, will you get up? Will you find enough motivation to get up? When, like Vishal said, when you take a few punches, will you still get up? Because it's going to be at least a few years of your life, that commitment. So you get into it only when the answer of all this question is yes. Don't do it because a lot of unicorns are being minted every few weeks, and there's a lot of funding available in the market that may or may not be right for you. Do this only when you can. And sometimes funding is not even necessary. A lot of questions get asked from the funding perspective. You don't have to it's not necessarily for somebody to build a business which has to grow 3x every year, 5x every year. You can have a low to mid-size top line and a healthy bottom line sort of a business. And if you know why you are building this, you can continue to do that, whether or not you get that funding.
Yeah, that's
So,
true.
this is an important
Yeah.
topic. So I'll want to add in, because this is more important than any of the questions you asked. See, I like to take this example of Nawazuddin Siddiqui interview I've read in Bollywood. See, life में it is like saying कि मैं hero heroine बनने जाऊँ नहीं जाऊँ, मैं Bollywood जाऊँ नहीं जाऊँ. No one can answer it. See, Nawazuddin Siddiqui, I read an interview. He said, I didn't get a role for 10 years. 10 years I was sleeping on platforms or railway platforms or just whiling away my time, not getting a single role or very minuscule roles. He said, during those 10 years, I observed every character who was in my life or around me. And I built those characters, the repertoire of those characters, how they behave, how they think, how they feel, as a part of who I am. I am a good actor today because of those 10 years. I didn't get those roles. I was the nobody. So see, Nawazuddin Siddiqui, who will tell him to go and become a hero? No one will. His parents will not tell him to go and become a hero, right? Forget any validation. He doesn't look like a hero, but he is a hero. Not because he looks like a hero or he is a hero's son or heroine's son, because he believes in it. He believes, and he's a realistic view of that. And even if he doesn't get 10 years any roles, he's ready to do that, while use those 10 years to build those acting skills, because that is who he is. He wants to be an actor. That is his journey, his life. So it doesn't matter how much time it takes, but you have to believe in it, who you are, your own destiny, and by instinctively who you are, why you are there in this world. So once you understand that, it will not bother you and will not ask some of these, if I can say in a humble way, some of these questions. If you're
All right,
asking
so
these questions, that means you need to go through that journey.
yes, right. So, Vishal sir, as a co-founder, definitely the last bit of advice that you would like to give to our young entrepreneurs that might help them in setting up their future from prototype to a unicorn.
So I think again, those are not. I don't believe those are right questions. Prototype to unicorn. I think those questions. I think don't let people understand who they are. So you have to understand your journey in life as a founder. Those are very difficult journeys. You're trying to create something which has not been created. See, investors will happen, pitch deck will happen. Things you have to live with yourself, your journey. You have to somewhere develop that mindset and that instincts, who you are in your journey in life, what you're passionate about, whether you are good as an employee or whether you are a good as a founder or a co-founder, or how you want to live your life. You have to develop that conviction, that focus, that clarity, and be a specialist in the field you want to really grow in, be it be AI or robotics or genomics or biryani or cloud kitchens or cloud computing. And 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 finally understand who you are and the journey you want in life. Being starting a company is a subset of your journey in life. You to understand that everything else will follow, and be
All
comfortable
right.
by living that journey.
Thank you. Thank you so much,
Yeah,
Vishal sir,
yeah,
for
perfect.
that.
I can't say it better than that, which I'll happily put.
Hmm, hmm, hmm,
Right.
hmm, hmm.
Manish sir, would you
Thank you.
like to
Best of luck to
enhance?
everyone. I think
Would you like to, enlighten some of the advices that you would like to give to the budding entrepreneurs who are, looking for the investment? The last bit of advice for today's evening.
I don't think I can better what Vishal has already said. And the last few minutes of the conversation we have had is the most important. Figure out the why you want to do this,
Yes.
whether you will do this if there is nobody else standing with you. ये ट्रेन चलने वाली है क्या, कोई चढ़े नहीं चढ़े, is this going to go, and then everybody will ride along. So वो आप you start doing it, you take baby steps, start doing it, start experimenting. I think you'll find your answers very soon. Don't wait for the perfect moment to say कि यार अच्छा ये होएगा, then I'll do this. If this is unstoppable, it has to be unstoppable. You should be losing sleep. कि अगर I don't want to be wasting one another day before I want to start. It has to be that compelling for you to do something.
Right. Thank you. Thank
and
you
it's
so
a
much,
marathon.
Manish
It's a very
sir.
long journey. Be ready for that.
Yeah, perfect.
That's true. That's true.
Thank
Thank
you,
you so much,
everyone. Best
Vishal
of
sir.
luck.
Thank
Have
you,
a good
Manish
weekend.
sir.
Yeah.
I guess this
Have a
session
good
was
weekend.
very
Thank you very much.
interactive and very informative for all of us.
Thank you very much.
And thanks to Startup Stairs for giving us this platform to connect together and to interact with the great minds like Vishal sir and Manish sir. Thank you so much, sir, for joining in with us. And to all the audiences, I would like to say, I hope we have cleared all the questions that you were. We tried our level best to inculate your questions also with our own conversations. So thank you so much to all the audiences who have joined us. Thank you, Startup Stairs. Thank you, Vishal sir, once again, and thank you, Manish
Thank
sir,
you,
once
Janvi. Thank you,
again.
everyone.
Thank
Thank
you
you.
so much, sir.
Thank you.
And
Thank you.
people, you can definitely, follow Startup Stairs on all the platforms, like all the social media platforms. We have given our links in the chat columns. So you can just search that, our Facebook ID, our Instagram ID, Twitter, and LinkedIn. And we can connect further for more such sessions, for more interactions with the great minds. Thank you so much once again.